Talk about credit. This is an education on your credit and how your credit score is derived. There are 55 different algorithms that create your credit score. So a mortgage company comparison to auto, compared to credit card companies, to Credit Karma, we all have different algorithms or formulas that create the credit scores. A mortgage company, because it's the biggest debt you're ever going to incur, has the most strictest algorithm. So when you think your credit score might be here based on Credit Karma, it's typically different when you talk to a mortgage professional. Tip number 1, revolving credit or credit cards. This makes up 30% of your score. So the way that credit card companies report, they typically report when several days before your balance is due. I bring this up because it's very important to understand this. Now, when your balance to limit at the time of reporting, or in other words, going onto the credit report, if that balance to limit is over 50%, it negatively affects your score. So it's always good to keep your credit cards below 50%, ideally below 30% at all times. Now, it's okay if they goes higher. We have simulators that we can run and tell you that if you pay down a particular credit card, this is what it projects as far as where your credit score would go to. Now, it doesn't matter if you have a $5,000 credit card or a $500 credit card. They are all weighted the same. A good rule of thumb is to have at least 3 credit cards. And this is why. Because this is an algorithm, and it doesn't matter how big the credit card limits are, they're all weighted the same. So you should use one for credit card simply for gas, right? So that way you just use it for gas. Another one maybe for groceries, and then another one that you do the majority of your spending on. So that way, if you do spend a lot one month, you have one credit card that is over 50%, but you have 2 that are below the 50 or below 30%. And then they balance it out and it keeps your score high. Tip number 2 is don't be late. It's okay if you are. After 2 years, whatever you have a derogatory item on your credit, eventually it does not affect your score as if it was recent. So after 2 years of passing on a late or a collection, eventually it's not going to be affecting your score as much. Tip number 3, installment debts. A lot of times people bring up like, oh, I just got a car, that should help out my score. Installment debts like cars don't have that big of an effect on your credit as long as you're not late on that installment debt. After 12 months of having that debt, that's when it actually helps out your score, but not as much as the revolving credit cards that I mentioned previously. Tip number 4, collections or medical collections. So this is how it works. Every trade line or debt that's on your credit report, they pay money to each one of the bureaus. There are 3 bureaus. And so over time, eventually, when that collection, they get tired of paying to each one of those bureaus. So they might stop paying to this bureau to save money. They might paying to this bureau. And then eventually they just get tired. They feel that they're not going to get the money back. So they stop reporting and paying every single month to all the different bureaus. So over time, that collection becomes an unpaid collection. One of the biggest mistakes that I find is sometimes people try to prepare and they might pay different debts off, like an unpaid collection that's over 2 years and therefore is not affecting your score as much as what happens when you paid the collection and now it's a recent paid collection and it actually brings down your score. All right, one of my personal favorites, one of the biggest myths in our industry, that is having your credit pulled. A lot of people are concerned about having the credit pulled or having an inquiry on their credit, feeling that that will decrease their score. This was really created by the mortgage industry or loan officers to deter clients to go talk to other lenders. Think about it. Why are they going to ding your score because you had your credit pulled? Now, during a 15 to 20 day period, you could have your credit pulled as many times as you want, and it really counts as one credit inquiry. Now, if you get to 60 days, 90 days, and you've had your credit pulled by 50 different lenders, then it's going to have an effect on your credit, and it could drop your score 5 to 10 to 15 points. It's not that big of an effect. And the best tip of all is don't try to do this yourself. I am a mortgage professional. I look at thousands of credit reports every year. We can look at it instantly and give you proper advice, and more importantly, direct you to appropriate people if you need professional help with increasing your score. So don't prepare to prepare, just take action and let us look at it, and we'll give you really, really good sound advice what you need to do.